This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City the evening of June 16th. The Federal Reserve gave the market a scare today when it released its bi-monthly Federal Open Market Committee statement at 2 p.m. A little appendix to the Fed statement indicated that the Federal Reserve governors expect modest increases in interest rates sometime in 2023. And if you look at the chart of the day, you see that the moment this came out, Treasury yields spiked and stocks fell. Treasury yields have risen to the highest level in a year, although, of course, they're extremely low by historical standards. The Fed governors are now admitting that there's something to the inflation story. They changed the language to say that inflation has been running at less than their 2% goal. Now they're saying, well, it has run in the past below their 2% goal. And the Federal Reserve bank presidents changed their inflation estimate this year to 3.5% from an earlier 2.2%, although they also insist that next year inflation will be just 2.2%. I don't think that's true. I think we're going to get more price increases and more bad inflation reports. This is only the first shoe to drop, and we're going to feel as if we're living downstairs from a centipede as more and more and more shoes drop. We had yet another piece of bad inflation news today. That was on import prices, up more than 10% over the past year. Now, there's a simple reason why import prices have been rising. The dollar has been falling. So in dollar terms, it costs more for the United States to import what it needs. And because the solid wall of demand created by federal stimulus has increased imports, imported inflation is extremely important. Now, we know by looking at past data that it takes about a full year for the effect of dollar devaluation to work its way through import prices, so there's a great deal more to come. We also know that the nearly 20% annual rate of increase of home prices in April hasn't fed its way into the shelter component of the Consumer Price Index. That tends to happen over 12 to 24 months. So import prices, home prices, used car prices, and many other aspects of the demand push inflation will continue to work their way through the system, and the Federal Reserve will gradually give ground and admit that inflation is a problem and talk more about higher interest rates. So we expect bond yields to rise, we expect stocks to struggle, and the best thing you can do is to buy hedges against rising interest rates. I'm David Goldman, speaking to you from New York on June 16th.